We just witnessed the second largest bank failure in US history, and I believe it's important for you to know how a bank could still be this massive and still fail. See, banks operate on what's called fractional reserve banking. That just means when you deposit $100 into the bank, they can actually invest or loan out 90 to 97 of those dollars to someone else. That means banks operate with just a fraction of your deposits on reserve, and you'll see why that plays such a huge role in this scenario. So this bank in particular deals with a lot of tech companies. So in effort to get new clients, they offered higher interest rates on deposits than their competitors. So in order to fund these higher interest rates, they use a lot of their cash reserve to buy treasury bonds, which are usually low risk. And they just so happen to buy a substantial amount of these bonds when the feds lowered the interest rates to nearly zero. So a quick lesson on bonds are that when interest rates are high, the bond price is low, and when interest rates are low, the bond price is high. So their timing was absolutely horrible, because when the feds raised interest rates to help fight inflation, the prices of those bonds dropped dramatically. And on top of that, a large chunk of the bank's clients were tech companies, and the high interest rates dropped the value of those companies as well. So in order to maintain normal operations, those tech companies had to start withdrawing their own money out of the bank. And because the bank didn't have that cash on hand, they had to sell a lot of those bonds at a loss of $1.8 billion. And when the bank reported those numbers, people got scared and tried to withdraw $42 billion just on Thursday alone. And at the close of business on Thursday, the balance sheet for the bank showed negative $1 billion. And that's when the regulators shut the bank down and made the FDIC the receiver of the bank. And the really sad part is that the FDIC only covers $250,000 of deposits per customer. And it was reported that over 90% of those deposits are more than $250,000. So this is going to have a major impact on all the companies that did business with this bank. We're talking a horrible ripple effect here. And because of fractional reserve banking, unfortunately, this can happen at any bank. And if someone has funds more than $250,000, it won't be covered. So you probably want to start looking at multiple places to put your money.